Well, let's get to the yield curve, Rick. Your view on what's happening right now. Treasury yields with a little bit of a lift. If you think about where the Fed funds rate is, at the upper bound, what are we, 175 on Fed funds? Yields right now at the front end, 164 on a 2-year note. Can you reconcile those two things?
So I'd say a couple of things. The front end of the yield curve is incredibly attractive today for a variety of reasons. One, the Fed is going nowhere. The Fed will watch this number and say, great, we're going to let it run hotter. We'd like to see inflation accelerate. The Fed's doing nothing. However, if the economy does slow, the Fed's going to cut rates. The 2-year note is pretty hard to sell at these levels because you've got nothing but reasonable carry. You think about where we've been over time. Plus, you've got an asymmetric risk reward. So the front end, we think, is really attractive. The back end in today's economy, I think you should have some because of the ballast it provides to a portfolio. But gosh, you think about where inflation is today. We're still running, whether it's core CPI or PCE, at about 2%. Back end of the curve. Think about where we were last year. 10-year was 3.25. We're sitting at a 183, 184 10-year now. Not that interesting. It's okay. It's okay. I don't own a bit in a portfolio, but would I own a lot? Not really.